Hi there, welcome to Kneppy Invest. First, viewer suggested video, financial year 23 result video. I did ask viewers of this channel to give me one company they'd like me to do a video on in regards to their financial year 23 results. Had like 40 suggestions. I put all those suggestions on a piece of paper, one piece of paper per company, and I put it into my Yellowstone hat here, and I randomly selected one company as the first company I'll do a video on. And I've decided just to do this process again. So in a second or so, I'll actually draw out the second company that I'll do a video on. Quite excited to do a video on Close the Loop. This is a recent IPO. They are definitely in the right space. I'll talk about what this company does in a second. But before that, I am going to draw out the second company that I'll do a video on. And more than likely, I will release this video on Monday, the 11th of September. And when I say this video, I'm talking about the second company I draw out. And that company is ECL. When ECL, which is Excelsior Capital, was suggested, I had a quick look at that company because I had no idea what Excelsior Capital do. In fact, as soon as I saw the name Excelsior Capital, I thought maybe a fund manager. And this company really intrigues me, so I am quite excited to be looking at Excelsior Capital. The other thing I should say is a lot of the companies suggested are intriguing, are really interesting. So I do have to congratulate viewers of this channel because they have picked a really good range of interesting companies. So watch out for that video on Excelsior Capital. Now on to Close the Loop. Now this company listed on the ASX maybe 2 or 3 years ago. I actually was a shareholder of this company for a short period of time, and then I took some profits because I'll talk about why I took profits later in the video, but this company is really intriguing because they're definitely in the right space. Now, before you know what Close the Loop does, let's talk about the circular economy, which is a little bit different than the closed economy. Closed economy is when a country can produce all the products and services themselves. They don't need to trade with any other country. I don't think there's any country in the world that is like that. Circular economy is a little bit different. And if you do look at the definitions of circular economy out there, for instance, the European Parliament, I do have a definition right here. It talks about a model of production and consumption, which involves sharing, leasing, reusing, repairing, refurbishing, and recycling existing materials and products as long as possible. And the word that triggers is sustainability. And sustainability is going to be extremely important in the future. If not, it's already important. And that's where Close the Loop comes in. Now, Close the Loop is, I wouldn't classify Close the Loop as a truly global company just yet, but they do have locations across Australia, Europe, South Africa, and United States. So they are on the way of becoming a truly global company. Now, Close the Loop create products and packaging that includes recyclable and made from recycled content, as well as collecting, sorting, reclaiming, and reusing resources that will otherwise go to landfill. So they recover electronic products, print consumables, eyewear, cosmetics, plastics, paper, cartons, and all that sort of stuff. They also reuse stuff like toners, post-consumer soft plastics for an asphalt additive. And the group or the company is focused on the future, sustainability, and the circular economy. Now to the financial year 23 results for Close the Loop. One of the small problems I have with Close the Loop, and one of the reasons I actually did sell, was simply because they are quite an acquisitive company. When I say acquisitive, I don't mean curious. I mean they do make quite a few acquisitions, and shares on issue have increased significantly over the past year or so because of acquisitions. Now, acquisitions in themselves are not bad, but research has shown that the majority of acquisitions actually do go bad for a company, particularly larger companies. Now, I wouldn't classify Close the Loop as a large company, but there is a possibility the more and more acquisitions they make, eventually one or two of those acquisitions will go badly for the company. So I would prefer the company to have more organic growth and not grow through acquisitions. Another problem I have is when I did have a look at their financial results, they didn't break down their growth into two sections, organic growth and acquisition growth. And I would have liked to see that because revenue growing at 52% per year and profit growing at 113% per year is really good growth. But how much of that growth was because of acquisitions? I don't know, because they actually didn't mention that in their financial year presentation or accounting or whatever you want to call it. Gross margins 35%. That's pretty nice. Operating cash flow 20.9 million, but the free cash flow 5.2 million. So they did spend a fair bit of money on capital expenditure, and they do also have a little bit of debt because of I believe their debt increased because of an acquisition. Now that's net debt. They have a fair bit of cash as well, but net debt of 38 million, and that does making me a little bit wary as well. And one of the reasons they are in debt, as I mentioned before, is because of acquisitions. Return on equity up to 13.8%. So that is in the sweet range. I like to see return on equity at least above 10%, preferably above 15%, but 13.8% is pretty good for a company like this. Return on invested capital, I would prefer that to be above 10%. And the reason why return on invested capital is about 4.4% lower than return on equity is because of that debt. Equity, 124.1 million. Now, always compare equity to the markup, that sort of thing. And equity actually did increase a significant amount in the past year because they did a fair bit of, well, maybe one really big capital raising, which increased equity by a fair bit. And you can see that increase in equity through the increase in shares on issue. So at the start of financial year 23, they had 335.5 million shares on issue. Now they have 515.7 million. And if you times that by the share or the share price, that means the markup of this company at the end of trading on September the 7th was 213 million. Now onto the valuations. P/E ratio 17.5. Now, this is where it does become interesting. You can actually calculate the P/E ratio using a different shares on issue and get a really smaller number. If you have a look at the company's annual report, you'll notice the weighted average shares was something like 300 million, which means if you do actually calculate the P/E ratio, you would get a significantly lower number than 17.5. Now, the reason they look at weighted average shares during the whole year is because they did a significant capital raising maybe 3/4 of the way through the year. So the weighted average shares is going to be significantly lower than the shares on issue at the end of the financial year. I like to be a little more conservative, and when I calculate the price earnings ratio, I calculate it using the amount of shares at the end of the year, which was over 500 million. Price to book ratio 1.72. Now, the other problem is because this company is new on the ASX, we don't know if these numbers are high or low. These numbers could be really high or be really low. So we can't compare these numbers to historical ranges for this company. And that is one of the problems with a recent IPO. Price to operating cash flow 10.2. And typically I'm looking for price operating cash flow between 6 and 10, particularly if I'm looking at EV to operating cash flow. Now the EV because this company has net debt, the EV is a little bit higher than the price. So the EV to operating cash flow is actually greater than 10.2. Now, also did a reverse DCF. What sort of growth in earnings per share will this company have to see for me to get my 10%, at least 10% return per year? This is not including dividends. And that number is only 6.6%. I definitely could see this company increasing the earnings per share at 6.6%. They also mentioned that one of the acquisitions they made, maybe the biggest acquisition, they only saw 2 months of financials from that acquisition. So there is potential that some of these financial numbers, some of these numbers like profit, revenue, will significantly climb in financial year 24 because of this one acquisition. So keep that in the back of your mind as well. So I do expect earnings per share of this company to increase significantly from here over the next 5 or 10 years. But the only thing holding me back is just the potential that this company makes more acquisitions in the future, and then eventually 1 or 2 of those acquisitions go badly. Typically now, what I like to do is have a look at the historical revenue of the company over at least 5 to 10 years. But because this company has been listed on the ASX for like 2 or maybe 3 years, I don't really want to do that. So instead of doing that, I'm going to have a look at the disaggregation or breakdown of this company's revenue into their divisions and also by geographic region. So this company has 2 divisions, packaging and resource recovery. And hopefully those names of those divisions are quite self-explanatory. For example, resource recovery is the take back, recovery and reuse of complex waste streams, including imaging, consumables, electronic equipment, cosmetics, plastics, paper, and cartons, etc., etc. And when you do look at the breakdown in revenue between these two divisions, resource and recovery is slightly bigger than packaging, 74.3 million to 61.6 million. But when you look at the EBITDA and profit breakdown of these two divisions, by far the better performing division is packaging. So even though resource recovery had more revenue, it had significantly lower profit, $3.2 million of profit in resource recovery compared to $9 million of profit in packaging. So by far the biggest margins in this company is packaging. Now, something interesting I found in the company's presentation was this revenue breakdown by division on the left-hand side and by geographic region on the right-hand side. Now, in financial year 23, which is the top part of the slide here, we can see that resource recovery had 55% of the revenue, packaging 45%. And remember on the previous slide, I said there was greater margins in packaging. So I would prefer packaging to become the biggest part of this company. But in financial year 24, they actually expect resource recovery revenue to grow at a greater rate than packaging. In fact, in financial year 24, they expect resource recovery to have 62% of the revenue, packaging 38%. So I wouldn't be surprised to see margins actually decrease in financial year 24. And then on the right-hand side, we have the geographical breakdown of revenue. So in financial year 23, 55% of this company's revenue was in Australia, 32% in USA, 9% in South Africa, and 4% in Europe. But by financial year 24, in 1 year, the majority of their revenue would go from being in Australia to now being generated in the United States. 52% in the United States, 40% in Australia, 5% in South Africa, and 3% in Europe. Now onto the daily chart for Close the Loop. This goes all the way back to when the company lists on the ASX back in late 2021. And this is actually an unusual chart for a company that has listed on the ASX over the past 2 or 3 years, because the majority of companies' charts have listed on the ASX during that time frame are quite negative. Most of those charts, the share price is in a well-defined downtrend. And the reason why those share prices of those charts of those companies are in well-defined downtrends is because the majority of those companies are not profitable. That's not Close the Loop. This company is profitable. Not only that profitable, they are growing. And that's why this chart is a little bit unusual for recent IPOs. Now, the share price has increased since this company listed. Back when it listed, the share price was a little bit volatile the first few days, but it was around 30 cents. Now the share price of Close the Loop is 40 cents. So it's talking about a 33% rise in share price over the past 2 years. But the share price has been as high as 49 to 50 cents, 4 times in the past 2 years. Twice the share price got to 49 cents in 2022, and twice the share price has got to 50 cents in 2023. So it does seem like 49 to 50 cents is a strong resistance level for this company. And really interesting, on trading or during trading on the 7th of September, share price of this company fell all the way down to 36 cents. And then we saw a really good bounce in the share price, and the share price closed at about 41 cents. So a lot of buying came in when the share price fell below 40 cents. So obviously, because this company is profitable, some investors saw some value when the share price of this company fell below 40 cents. And that actually is a good sign for Close the Loop moving forward. Now, if I saw the share price of Close the Loop get above 50 cents on strength, on really good volume, preferably on a really good financial announcement, that would be really bullish. On the flip side, if the share price fell below 32.5 cents on strength, on really big volume, on a negative news from the company, that would be a really bad sign. Now, if the share price fell in a range between about 32, 33 cents, and around about 39 cents, that could be good buying if you are excited about the future and the potential of this company over the next 5 to 10 years, just like what happened on Thursday, the 7th of September. Now, I would not call Close the Loop cheap or expensive at these levels, but I do expect some good growth in this company over the next few years. And that's why this company is intriguing. But on the other end of the spectrum, because this company is quite acquisitive, they make a lot of acquisitions, that is the one thing holding me back, because I'm just a little bit wary of the potential of this company making at least one bad acquisition, and that could really harm the future of the company. That's all I have for this look at Close the Loop's financial year 23 results. If you have any questions about this company, if you're a shareholder of Close the Loop, I'd love to hear your opinion on this company and the performance of this company over the past 2 years. So leave your thoughts in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.